This is dire. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, a major country is on the verge of total economic Armageddon, and I want to understand that how the policies of the president of this country are the ones that are going to send it completely crashing into a financial crisis. And despite best efforts by the president and the political elites of that country, as you're about to see, you're going to find out that it's too little, too late, and there's nothing they can do to stop the decline. But the problem is, it's not just that their country's headed into a financial crisis, that if this country goes, that every major country around the world will soon follow. And with that, let's head over to Bloomberg, where we picked today's story up with a headline: as Country Garden's home sales slump persist as aid fails to help. And here we could look back that President Xi Jinping tried to curtail the speculation in the housing market by constricting the creation of credit. And at the time, we said this is a bad move because in a debt-based economy, when you start to constrict the creation of credit to pop a bubble, well, you risk sending the country into a financial crisis. At best, you get a recession. At worst, you're into an all-out financial crisis, and that's exactly where China's headed. And it's just now a matter of time before we see an all-out collapse in real estate prices, as contracted sales for May plunged a whopping 76% to 4.3 billion yuan from a year earlier, following an 83% slide in April. This trend was toward improvement as May of 2024 sales were 11% higher than a month earlier, though they were still at the third lowest level in at least 7 years. And can you imagine what a crash in housing prices would do? Well, it would send the banks in China into insolvency. Of course, we know that when new sales go, it's just a matter of time before housing prices follow. And the sales drought may exacerbate the cash crunch for Country Garden, whose crisis entered a new chapter after it made a surprise announcement in March that it will miss a deadline for reporting annual results due to insufficient information. Well, the reality is it's insufficient cash, because if new home sales are crashing like they are, that means they're not bringing in revenue from sales. And of course, if they were to publish their financial results, the world would quickly find out that Country Garden is insolvent, and that would likely mean that many other property developers are also facing imminent insolvency. And China's central government rolled out the most forceful rescue package last month to halt the 3-year downturn in the sector. And here we can see where Country Garden is based is among cities that have fallen through by lowering down payment ratios and minimum mortgage rates. And this is a problem because political elites do not realize that when you constrict the creation of credit, you can't just turn the economy around on a dime. And the Fed believes this too. They think that if the economy here in the U.S. slows a little bit, that maybe 1 or 2 rate cuts and everything will turn around. Then what they don't realize is that it's too little and far too late. Once you start the contraction of credit, it's game over. And that means, of course, rates are falling. And if you saw this headline yesterday, well, it got even better as 10-year treasury yields break below 4.3% and kept sliding. If you're wondering how you can make money on, of course, the market going down and economy starting to crash, well, we warned our subscribers here that they needed to be buying into the long run right back here, and we gave them the alerts. And right now, if they took that trade, not only they make money, but it went up again yesterday, and it's on its way up today. Here you can see the 30-year zero coupon, and this is something you can't buy this in your 401k or retirement IRA perhaps, but you can buy the long bond, and those returns are without dividends. How do we do it? Well, we have 2 reports. One that looks at the machine positioning. We try to find discrepancies when machines are deep short and prices are rallying against them and they have to cover. Well, we alert our subscribers to the opportunities. And maybe you're a technical trader, but you find yourself struggling to trade things like the RSI and the MACD. Well, we run a proprietary overlay. We smooth out the signals. That's called Momentum Timer Pro. And here's the best part of both is we just made it even easier for you to make money. Now we give a breakdown of every trade when they're reported. I give you my macro view when I have it. We tell you where to put your stop losses. We even follow up on existing trades, telling you when to raise your stop losses losses, and maybe when to add money. We give you all the details, quick and easy, right in text format. So you get the report, you get the text, and here's the best part. We're going to be raising prices soon, and you can lock them in right now. There's a 30-day free trial. If you jump on that, links in the description, you lock in the current price. You don't have to worry. We could raise prices and you won't see it. But here's the thing. You want to make money trading? We make it easy. We track the trades. We give you all the details, and you too can be successful, because what's going to happen in the global economy, if things are going to change and people are going to look for ways to make money, and we're going to have the answers as we look toward the slowdown that's happening in China. It's going to happen here in the US too, as we look at the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. And what this means is when banks constrict the creation of credit, they do it by, of course, lending less money. So when people come into the bank to borrow money, they fill out the credit application. Well, the banks start saying no more than they say yes, and the rules and requirements to get a loan, they get higher and more stringent. And that means, of course, people borrowing money, well, they just turn away. And because banks create money in a debt-based economy by lending, and that's the key point. So you need to see your commercial banks lending money here. And when they tighten credit conditions, well, what you know is the economy can continue to hum along as we look at real gross domestic product here of the U.S. But what happens eventually, those tighter credit conditions, the lack of money in the system eventually leads to a slowdown and perhaps an outright contraction in the economy. And that's exactly what's happening in China, because President Xi Jinping, again, he came in and said, look, the property market's in a bubble and it's all speculation, and I want to curtail that. So he started constricting the creation of credit. Little did he know that his entire economy is based on the housing market, and that his banks are over leveraged in their lending to the housing market, which is why, of course, their economy is going to outright experience an economic Armageddon. And as you're about to see, there's nothing they can do to stop it. As China's property stocks now fall 20% from the May high as concerns linger, and no surprise, new home sales at the 100 biggest real estate companies dropped 33.6% from a year earlier in May, easing from a 45% decline in April. And while a slight month-on-month pickup buoyed property shares earlier this week, worries over the long-term outlook later pushed investors to take profits. The reason they're trying to get out is because they're going to find out in the near-term future that these property developers are insolvent, and when that hits the market, the stock price is going to plummet. They're not taking profits. They're getting their money out while they still can, and that's a key point, because many of these companies are going to be into insolvency. As we just found out, Chinese developer troubles deepen as Dexon. They're getting liquidated, and there are only going to be more that follow. The state council, the country's cabinets, asked officials to keep formulating new policies that will absorb existing housing stock and stabilize the markets. And we talked about this in a show not too long ago, that Beijing's plan is to have, of course, local governments come in and buy properties, take them off the market, get rid of all supply. They think that's the answer. Of course, could you imagine here in the U.S. if the U.S. government came out and started buying up brand new empty homes? Could you imagine the outrage? Well, in China, that's what's happening, and it's not working. And here we can see, of course, that China's credit is now getting a lift from bond sales as loan growth slows. But the key part here is loan growth is slowing. In a debt-based economy, this is not what you want to happen. Of course, the challenge here for Beijing is the government is starting to take over a lion's share of the lending. And what you can have happen is governments can borrow, they can run deficits, but you need the private sector. You need consumers and businesses to borrow. When their lending starts to dry up and it's getting turned down to the government to do all the borrowing, well, it's now only a foregone conclusion that your economy is headed into recession, and China is headed there, the U.S. soon to follow. As the stock of aggregate financing, a broad measure of credit, expanded 8.4% from a year ago, slightly above April's figure. And this would actually sounds like a pretty good number. But the acceleration was largely due to a pickup in government borrowing and bonds being issued. And the stock of outstanding loans grew at an 8.9% pace, the slowest on record. And that is the challenge, because once you start slowing down credit creation, the problem is you need enough money to pay pay on the existing debts and to maintain the growth rate. The problem is you start to sacrifice growth, and then some people just can't pay on those debts. We're seeing that happen in the property market here. But the danger sign for China isn't if just the property developers go. It's the fact that the banks have lent a massive amount of money to them. And you might remember not long ago that Beijing pushed, of course, the banks to lend unsecured amounts of money to the developers. Well, that money's not getting paid back. And that means, of course, things are getting worse. And the evidence is the broad money supply measure, the M2, is also weakening. And we can see that here in this chart as China's loan stock expands out the slowest pace on record of loan stock, credit stock, and M2 money supply all decelerating. And much like a game of musical chairs, when the music stops, there just isn't enough money to pay on all the debt. And that's exactly the problem here. Consumers are tapped out. Businesses aren't seeing prosperity. Developers are running out of money, and Beijing's got absolutely no answers. And again, it all comes back to the banks, because when commercial banks lend, again, they create money. And at the same time, when loans get paid back, when the principal value of a commercial loan gets paid back, whether it's on a monthly, quarterly, annual, or even as a lump sum, it doesn't matter. That money is destroyed from the banking system. So one of the challenges is when you have a deceleration of credit, you don't have enough money to pay on all the growth targets and the existing debt. Even worse, when you get into contraction like the US, well, again, a recession or all-out financial crisis, it becomes, as I said, a foregone conclusion. We see what's coming in the U.S. We know what's happening in China. And of course, if China's banks go, that means banks around the world are going to have problems. As we look at the net percentage of domestic banks tightening standards for commercial industrial loans, and what we see here is as banks tighten standards, yes, you can see loan growth here shown as commercial industrial lending. This is the weekly data shown on a year-over-year rate of change. It can continue running just fine. Then all of a sudden it starts to decelerate, and it's this contraction right here where you start to see money being destroyed. And in a debt-based economy, that is the worst possible thing you can see, because here what happened? You had the dot-com bubble blow up because companies couldn't get financing. What happened in the global financial crisis? Well, banks nearly failed. And now we're in a very slight contraction here. If this turns down because the economy further slows in the U.S., well, watch out below. Again, it's only a matter of time before we too are in an all-out financial crisis again. And the numbers show China's once mighty credit engine, which used to power economic growth, is slowing over the long term. A real estate slump has dampened the appetite for credit among consumers and businesses. And this is a key point. Again, we talk about debt-based economies. You can have government borrowing, but it needs to come on the back of a strong private sector. You need to see consumers and businesses borrowing. When they stop borrowing and governments start taking on a bigger piece of the pie, well, it's a dangerous game. And while local governments have been forced to pare back their off-balance sheet borrowing, Beijing is now seeking new ways to sustain economic growth. And as evidence that they don't get it, they're looking at high-tech manufacturing. That part is great. That won't rely so much on expanding debt, but that's the problem. A debt-based economy does rely on expanding debt. Beijing doesn't get it. They're curtailing the creation of credit. They're going to send their economy crashing. The real estate sector is going to come outright into oblivion. It's just going to get destroyed, take the banks down with them, and that's going to ripple all across the world. And right now, their economy is likely the first to fail. As domestic demand is weakened, reflected in poor credit expansion. This is a case I've been making, and banks have problems creating loan assets. And it's not because banks don't want to lend. Banks, they're business. They want to lend. The problem is governments make it difficult. Here in the U.S., the reason lending standards are so tight is because the Fed has inverted the yield curve. They've made the cost of short-term money higher than long-term money. And the problem is banks borrow at the short end of the curve and lend at the long end of the curve, so they can't make money on the interest rate spread. This is a dangerous game, and this is why, of course, we see that China sells 50-year bonds at record low yield as demand swells. And of course, you may recall not long ago, Beijing warned the banks. President Xi Jinping said, hey, if you're buying bonds, well, you're an idiot, because we're in a massive bond bubble and you're going to get destroyed when rates go up. Of course, many American investors believe rates can only go higher, but it's all because they don't understand that interest rates are a function of growth and inflation expectations. We know that China's consumer prices are nearing deflation. We know growth is slowing, and that means interest rates are falling. The question is, why are banks buying? because they're not lending. They need to do something. They've got to back their assets with something that generates interest. They're the ones buying bonds. And this sales part of China's 1 trillion yuan special sovereign notes issuance for this year, as investors have been eagerly buying their bonds because they have no lending action going on amid lingering pessimism over the economy, despite warnings from authorities on the risk of a bond bubble, particularly longer dated debt. So again, the government's saying, don't buy this stuff. We want rates to go up. And the problem is the banks are buying it because they have nothing else to do. And the evidence that we see that interest rates are a function of growth and inflation expectations. I've taken the consumer price index and averaged it with the gross domestic product here in the U.S. and on the year-over-year rate of change, and I put that against the 10-year Treasury, that's shown in red, and where you see growth and inflation expectations by rising blue line, well, yields go up, and when that goes down, yields follow, and that's why we're seeing interest rates go down here in the U.S. It's not just a matter of the fact that the CPI came in at a 0 for the month. It's the fact that inflation is cooling and growth is also cooling. In a debt-based economy, to create credit, to create an expansion of money, to keep the economy going, to keep things from blowing up from a series of defaults, well, you need money to be created. You do that with low rates, not higher rates. That's something the market here doesn't get. And even we see it in the oil spaces. China's oil refiners are slowing down after decades of growth. Again, another sign when energy demand goes, well, it means your economy is falling, as China's refined a record 14.76 million barrels a day for the last year, known as crude throughput, as demand rebounded after the pandemic, but the recovery is showing signs of faltering. The International Energy Agency said that the nation's refinery run slumped to COVID-era levels in April. Can you imagine if that happened here in the U.S.? It just goes that how bad China's economy is, that President Xi Jinping's actions to slow the speculation in the property sector is going to send this country into all-out economic Armageddon. The actions of the Fed are going to send the U.S. into the next financial crisis. And here you can see when lending standards tighten, well, crude oil prices and demand goes. As you see, every time banks tighten standards with a lag, energy prices, here shown as West Texas Intermediate, they eventually come crashing down. It's only a matter of time now before we see demand for energy in the U.S. plummet. And Xi Jinping has few options to punish EU without starting a trade war, as things for the country get worse, because he turned to exports as a way to turn around his economy. But he's finding out that nobody wants his cheap goods because they need their economies to continue running too. And if China responds in kind with aggressive tariffs, they risk triggering a trade war, and Beijing is desperate, he said, to avoid that. Well, they're not just desperate to avoid that, they're desperate to keep their economy propped up, because the last thing China wants to do is be the country that sends the world into the next global financial crisis. It will be bad for them politically for a long, long time. The problem is, at the rate things are going, we're now a matter of months before China's economy hits total economic Armageddon. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.